Welcome to the NISM Masterclass. I am your host, Sashi Krishnan. Our purpose at NISM is capacity building for the securities market. And as part of that purpose, we sit down with the market experts to get a stronger understanding and gain deeper insights into various facets of the securities market. And my guest today is Preeti Chedda. And Preeti is the CFO of K. Raheja Corp Investment Private Limited, who are the managers to Mindspace Business Parks REITs. And Mindspace is one of the four commercial REITs that operate in this country today. She's also on the executive committee of the India REITs Association and is a member of the Hybrid Securities Advisory Committee of SEBI. Welcome to this masterclass, Preeti.
Thank you for having me.
Preeti, right up front, I wanted to ask you, why do real estate investment trusts or REITs matter for investors and developers? I mean, coming specifically to investors, today investors have got a choice of a number of pooled investment vehicles. They could invest into mutual funds, they could invest into PMS schemes, they could invest into alternate investment funds. So why should investors, especially retail investors, look at REITs as part of their portfolio?
Right. So firstly, thank you for having me here. Let me start with what the product is, and then I'll come to retail investors in specific. So this is, as you rightly said, it's a pooled investment vehicle. Generally, in a pooled investment vehicle, obviously, you can have different asset classes. This asset class deals with real estate. So any form of real estate, whether be it offices, shopping centers, hotels, could be data centers, could be warehouses. So all of that fit into this whole gamut of real estate. There is another, I would say, co-asset class, which is infrastructure. So for that, while the regulation is broadly similar, they are called infrastructure investment trust, which we in short form call InvITs. Right. So we have REITs and we have InvITs. So this is all real estate, and that's infra. Having said that, there could be certain asset classes which are defined as infra under the Ministry of Finance harmonized list. But if, say, a REIT is only giving them on, say, rent, for example, say a warehouse, if it's only on a rental model, it can come into the REIT also. Though it classifies under the harmonized list, it can come here also. So that's the asset class under which the REIT operates. Now coming to what the product is. Because under the REIT regulation, 80% of your portfolio has to be completed and rent generating asset. Right. So that's the first criteria. The second most important criteria is 90% of our net distributable cash flows. It's cash flow and not profits. Right. Cash flows have to be distributed at least half yearly, though almost all REITs and InvITs are distributing every quarter.
If I may interrupt you, yes. That remaining 20% could be in what kind of, sort of assets?
Sure. So the 20% can be under construction assets, which are within a project. So say generally I have a large project, which is say 5 million square feet project. I have 4 million, say, which is completed. Another million square feet, which is under various stages of development. So that falls in my 20%. If I'm having, say, any form of investment, say I have surplus cash and I've parked it, say, in mutual funds or fixed deposit, that also comes into my 20% category.
Could I buy mortgage-backed securities, for example?
Yes, even that's permitted. So all that comes in my 20%. Right. And 80% has to be real estate, which is completed and rent generating. So that's a criteria.
And if you are a new REIT, how quickly do you need to put your 80% into rent-bearing assets?
So that's the criteria on day one. When you form the REIT, unless you meet this criteria, you can't be a REIT.
Right. Okay.
So this is a criteria which is on day one, and it's a continuing obligation. Right. So at any point in time, you have to be there. Sure. So they give you 6 months cure period in case because of valuations moving up and down, changes, but you need to get back again. Right. So now the fundamental thing is, because it's completed and rent generating, I would say the uncertainty of cash flow is limited. And I think the beauty of the product is because most of the real estate is backed by long-term contracts. So if I were to take office asset class generally has contracts of 9 years, sometimes 10 years or 15 years also. And we've seen that when we as an asset provider make an asset, say we spend 8,000 rupees to build. But today the tenants spend much more on fit outs and infrastructure. They sometimes spend even more than what we spend on making up the whole building. Right. So therefore, there's huge amount of stickiness. So while the lock-ins could be 3 years, 5 years, they generally all continue for the full term, which could be 9 years, 10 years, 15 years. Right. So therefore, there is certainty of cash flows for the 10-year period. So that makes this a very stable instrument. It's not volatile or seasonal that today goes up, down. You don't see that volatility. And the cash flow is very predictable because we have inbuilt escalations of 5% annual. So my rent, say it's 100 today, tomorrow it becomes 105 and then just moves up and up. So there's an inbuilt growth which is embedded in the portfolio itself.
If I may ask you a question, is it a closed-ended structure or an open-ended structure?
It's a close-ended and it doesn't have a fund life, so to say. It's an infinite life vehicle.
Right.
So it's very similar to a company. It's just that it is, in terms of construct, it's a trust, but otherwise it's very similar to a company. It's listed on the stock exchanges. It's listed on NSE, BSE. The unit, trading unit is just one. So you can actually go and buy just one unit, similar to the way you buy stock. So if you have a demat account, if you have another online account, you just go online, buy the unit. So it's as simple to buy and sell as is for a normal equity stock.
So why, again, is the question, should a retail investor get into
Yes.
this?
So
asset
two
class?
things. One, stability of cash flows. They get recurring distribution. So we pay every quarter. The distributions are generally in the range of 6-7%. The yield, which we call, is about 6 to 7%. So today, if I bought a stock at, say, X price, 6-7% is a distribution that you can expect. So
Right.
that's number one. Second, there is capital appreciation. Because our inbuilt contracts have escalation, and generally in India, we have seen the inflation has been higher than the 5% escalation, which is inbuilt in our contract.
Right.
So what happens at the end of the 9th or the 10th year, you actually get a pop in your rent as compared to what you were getting from the current tenant. So that's another 2-3%. So that 5% plus another 2-3% then gives you another 6-7% in form of growth.
Right.
So you're getting distribution yield of, say, 6-7, you're getting growth of 6-7. So the total return that somebody can expect will get to the range of 12 to 14%. So that's number one. So when you compare,
So should I compare this with a rental yield, or should I compare this with a yield I get from a bond, say?
you should look at this instrument a little different from all these other instruments, and I'll come to that, why not all the others and why this. But I think you should look at it as a total return. One, for anybody who's wanting regular income, this is a product. Plus, somebody who's just not satisfied with just getting the same amount of income but wants to see a growth in capital.
Right.
So this is a product which is giving you the best of both. It's giving you recurring income. At the same time, it's giving you growth.
Right.
And a combination of the two is the 12 to 14% that I'm talking. I think another thing is because it's a tax efficient instrument. REITs globally have a single level of taxation, and that's the case in India as well. So the SPVs, where all the assets are held, pays the tax. It's a trust, it's a pass-through structure. And when it comes to the retail investors, we'll come to the different
So it's
forms.
more tax efficient than...
As compared to the other instruments, dividends are fully tax exempt. So that's the reason why it becomes more attractive for a retail investor.
And what about from the developer perspective? So why would a developer sort of want to monetize, or raise capital through a REIT structure rather than outright selling the property?
Right. So if you were to do a normal, when you sell any asset, then obviously one, you entail stamp duty, you pay capital gain. It becomes very transactional heavy, transaction cost
Right.
gets very heavy. Second thing is, this is very similar to a listed company. So it gives you access to capital for growth. So today, once you're listed as a REIT and you want to keep buying more assets into the portfolio, you have multiple ways to raise capital. You do QIBs, follow-on offers, or you raise debt. There are multiple ways for you to raise. And debt also, I'm saying not just from banks, you can do access a debt capital market, you do bonds. So your access for growth capital becomes far more easy. Second, you create the liquidity. So today you have a liquid instrument with you. And because this is an asset class where you can keep seeding assets into this vehicle. So today, and if you see globally, any large corporates, they have a development organization, which is a different where the development happens because there is development risk associated. Whereas this is a core asset where you don't have much of development risk because 80% is complete. And most of it is rent generating, so there's less leasing risk. So here it's a very sanitized portfolio as compared to a development risk. So generally, internationally also, you have a development company and then you have a REIT.
Okay.
That's how it's evolving in India also, where developments are happening on the private side and all the completed assets are then getting in.
Moved into the REIT.
So that's why this is a very well preferred vehicle even for a developer.
Yeah, but then you have limitations on the amount of leverage that you can take in a REIT, right?
Correct.
So you just can't keep increasing leverage.
Yeah, but the way you should look at it is because the development also is very limited in a REIT because you can't go beyond 20% and the 20% covers various other things also. So therefore the development is limited, and if the development is limited, for your need for expansion capital is also limited. So today while SEBI allows us to go to 49%, all of us are in and around or even lesser than 30%.
Right.
We've not even reached our 49% limit.
Correct.
And this, any which ways, is a vehicle which is a moderate risk, moderate return vehicle. So you don't really want to have very high leverage and make it more vulnerable. So that's the way the product is.
So if this is an instrument that's good for both the developer
Developers,
and for
absolutely.
the
Yes.
individual
Correct.
retail investor or
Yes.
institutional investor,
Absolutely.
then why is it that we still have only 4 commercial REITs in India? Like worldwide, there are close to around 900 REITs. Even
Correct.
Asia is seeing something like 225 REITs.
Yes.
The market cap of REITs in the US is something like 1.3 trillion. In India, we are at say 90,000 crores or
Correct.
something like that. It's not very, very large. So what do you think is the reason that REITs haven't sort of taken off? And more importantly, what do you see the prospects,
Over.
say, over the next couple of years?
So let me first look at real estate and then we'll come to infra.
Sure.
If you look at the way REITs have evolved internationally, I think in the last 10 years, it's been 10 years since the regulation came in, I think we've made very good progress. If you look at the same 10 years in US, ever since the 1960s that it
Right.
came in US, in the first 10 years, they did not achieve the scale that we've achieved in the last 10 years.
Okay.
And I think that will all, the credit would go to SEBI for enabling such a good regulation. And I'll tell you why it is taken off, and we just have 4 REITs today. So today the asset classes which can actually get into a REIT in India especially would be office, purely from a real estate
Correct.
perspective, could be shopping center and hotels.
Right.
Residential in India cannot get in simply because we sell residential. We don't give enough residential on leasing. That's not been the Indian model. Indians like to own properties instead of leasing properties.
Right.
And for anything to come under the REIT umbrella, it should be a let asset, income generating. You can't sell. If you sell, it cannot come. So residential, at least as of now, is ruled out.
Right.
In India, major chunk of real estate is residential.
Right.
Office, and all of them are relatively smaller as compared to the whole.
No, but what about warehouses, tech parks?
I'll come to
Could
that.
they all come into
Yes, all of those could come.
into
So-
these commercial REITs?
Yes, it can.
Right.
It can. So we already have one warehousing REIT, InvIT. It's not actually come in REIT.
Right.
It's an InvIT because warehouses, data centers fall under the the classification for infrastructure by the MOF.
Okay.
So they've gone and sat there.
Okay.
So whether it is REIT or InvITs, for sure these asset classes have already come in.
Right.
In India, the entire office stock is about 700 million square feet.
Right.
Out of that, lot of it is strata sold. So in the sense, each say floor or each unit is sold to different asset owners.
Right.
So you don't have consolidated portfolios. What is REITable, as we call, is will be about say anyway 450 million to 500 million.
Right.
Out of that, 125 million has already come into the REITs. So you still have 4x growth that can happen. To answer your question, where do you see?
With the existing stock.
With the existing stock. And
Right.
we keep adding about 50 million net stock
15.
every year, 50.
50.
Yes, we keep adding every year. So eventually, so what has happened is earlier people had already formed listed companies. Like for example, there are already listed
So
companies.
all
which
these REITable stock that is available, they're all A-grade buildings?
they are absolutely A grade. When I say REITable, they are A grade institutional assets which can actually come into REITs.
Okay.
And I think it's a matter of time because you have 4 REITs which happened in the last 5 years. There are already one more REIT which has filed the offer document. There are others also, as we hear, who are working on REITs. But you'll eventually start seeing each of these owners getting into REIT. Because I think because it was a new product, people did not want to move first because want to see how this product evolves. But I think 5 years has demonstrated there's enough space for this and the product can really do well. And therefore now you'll start seeing more REITs coming. So the whole 450, 500 million square feet will over a period, I'm not saying it'll happen today, tomorrow, but will over a period start finding place in the entire REIT sector. And also there's a lot of consolidation happening. So today portfolios are getting acquired either by REITs or say private equity, which will eventually start coming. So like for example, today out of the 4 REITs, one is a Blackstone sponsored REIT, one is a Brookfield sponsored REIT.
Right.
So they have larger portfolios available on private side, which eventually someday or the other would start finding ways. Now, if you see on the infra side, you have huge amount of money which is already come into InvITs. Today you have more than 15 road InvITs.
Right.
You have renewable energy InvITs. You have power transmission InvITs. You have warehousing InvITs. Today, all of those asset classes will only get bigger and bigger as the thrust of government on infra also is great. So they'll get only bigger and bigger. And I think today we have two government InvITs. We have NHA and Power Grid, and I'm sure there'll be many more which can come. Government can meaningfully use this for monetization as well. So I think the sector is poised to grow. It took off on a slow start because India did not understand this product. Today, our biggest challenge is that not everybody understands what a REIT is. And I'm not just saying the retail investors, institutional side also the learning has come over a period. So initially we also only FPI dominating this asset class. Then it went to mutual funds, then insurance companies came in, then we had pension companies came in. So over a period you are seeing more and more investors coming, and as more and more people start coming into the place, I think the asset owners also will start looking at these.
Okay. So you're talking about this 500 billion square feet that is
Correct.
readily available, that can be
Yeah.
REITable.
Yes.
Right. So beyond commercial REITs, I mean, the question I asked you a little bit, you have warehouses, you have logistic parks,
Yes.
etc. Some of them have gone into InvITs. Do you see
Yes.
those also coming into REITs?
Okay, so other asset classes, for example, we have one mall REIT.
Right. So we have only one today.
So they are the only one. Now in India, you have almost 70 million ready mall stock.
Okay.
Okay, now obviously some has gone into other listed companies. So for
Right.
them to now convert to REIT, there are own set of challenges, but at least a newer product or the ones which are not on the listed space can definitely see here. Now, for example, data centers, you spoke of data
Right.
centers. Like Mindspace REIT already has 1.5 million square feet of data centers within the REIT portfolio.
Right.
The office REIT, but there is data centers also. So data centers are already having a place, but
Right.
tomorrow large data centers can definitely look at this space. Warehousing has gone there, but it can also come into REITs. It's a choice which a manager has to make,
Right.
whether you want to be listed. So the only difference I would say, REITs are only publicly listed. SEBI regulations don't allow privately listed.
Okay. Well, InvITs
Whereas in
could be
infrastructure, they allow privately and public.
Right.
So asset managers who want to be privately listed, they don't want to go.
Right.
Sometimes it's also with your readiness. Today you feel, let me start with being a private, and once I gear up and get the scale, I will move to a public.
Right.
Then InvITs become logical choice because you can start with a limited investor base and then you can go full-fledged on the public side. That option is not there on the REIT side.
So that I'm a little curious. Say somebody has a warehouse, set of warehouse assets, he
Yes.
puts into an InvIT.
Yes.
At the time he wants to go public, can he then convert it into a REIT?
I mean, nothing has happened so far. I'm not saying it's impossible to do that. I'm sure SEBI can work around a structure that tomorrow if a privately listed InvIT wants to become a REIT, some regulations are a little different for both of them in terms of course, the asset class, but there are certain nuances in and around that. I don't think it's impossible. I don't think anybody has done that so far.
So, REITs in India, as you were earlier mentioning,
Yes.
operate through this SPV holdco
Correct.
structure.
Yes.
Whereas globally, most REITs directly own this
Yes.
asset. So I know there are certain taxation advantages, there are certain regulatory sort of advantage that you have by going through the SPV holdco structure. But what are the operational efficiencies that you gain or lose by going through this structure as compared to a REIT directly owning assets? And I think some REITs also directly own assets in India, if I'm not mistaken.
No, today there are no REITs.
So
which
there are no
directly-
REITs that-
Everybody has an SPV.
But they're allowed to
structure.
own
Yes,
directly.
They allow. The reg allows.
Yeah, the regulation allows
Yes.
them to use it.
Okay, so fundamentally, real assets in India have always been taking the SPV route, and that's for 2, 3 reasons. One, transferability is much better because it becomes far more cost efficient. So when you transfer a physical asset, there are implications in terms of stamp duty, capital gains, and so on and so forth. Capital gain, of course, comes even in case of a company.
Correct.
But those are the challenges. Second, when you're having an asset, like in India especially, we take loans for those assets.
Right.
When you have in a specific SPV, there's ring fencing which is happening for that asset because then you have full control of that SPV. And say tomorrow if anything goes wrong, then it's only that one SPV which is becoming vulnerable and not
Correct.
everybody
Right.
else.
Okay.
So that was a thought process years back when this whole SPV construct took place.
Right.
And that's how it's evolved. So the reason everybody continues to have SPV is again the same. The transaction cost on transfer is much better when it comes to an SPV, and there's ring fencing happening when you're raising loans for those specific asset classes. I don't see any disadvantage when even in a REIT structure, when you have two layers. In fact, in sometimes we also have three layers. You have a holdco and an SPV
Correct.
also, because those were the structures in which the SPVs were. So today, if I have on the private side, say have an SPV and another SPV below, for whatever reason, now when I'm moving to the REIT, I just moved lock, stock, barrel.
Right.
I have the option today to merge them if I wish to. If I don't need also, there's not too much of disadvantage. It's just that your compliance cost is much more. You have two levels.
Right.
I think the other thing is today, the way the REIT taxation is, when you swap the shares of a SPV with the units of the REIT, the tax is deferred. The tax remains. It's just that it's deferred when you actually sell the units. So for asset owners in India, it becomes a little more efficient when they are moving the assets into the REIT. If I'm just moving a single asset, not the SPV, then I have to pay tax then.
Right.
But when I'm moving a SPV, then it's a deferred taxation. I still pay tax, but I pay only when I sell my units. So from that perspective also, it becomes far more efficient to have an SPV. So these are the reasons why you have the SPV model going on for REITs and
So for the developer, it's a lot more tax efficient to go to the SPV and
Yes,
holdco route.
correct.
Whereas for the investor, it really makes no
So
difference.
investor, it doesn't matter, because at the end of it, whatever are the distributable cash flows, whether they are sitting in the SPV or they are sitting in the REIT, REIT regulations say 90% of your consolidated cash flows have to be paid out. So from an investor standpoint, it doesn't matter. They any which ways are going to get the money.
Right. So from an investor, it doesn't matter, but it may make a little bit of a difference to the investor from a taxation perspective. If they are directly owned and
No, not really, because even there is one level of taxation, whichever way you look at. If an asset is, say, for example, owned directly in the REIT is not paying tax, but say whatever it is, business income or house property,
Right.
as a case maybe, is paid by the unit holder.
Correct.
Here, what happens? The tax is paid by the SPV, and then the money moves up. If suppose if it's moving, I'm giving an example in form of dividend, then it's not taxable either in the hands of the
Right.
REIT nor the unit holders.
Right.
But the corporate tax has been paid at one level.
Right.
So I don't think there is any tax advantage or disadvantage either which ways.
What are the challenges that a REIT manager faces? For example, there are challenges in terms of the concentration risk, geographical concentration, because I don't think there are more than 3 or 4 cities in which,
Correct.
the
Correct.
REITs have their assets in.
Yes.
Right? Similarly, the caps on leverage you talked about, you're saying that as of now, nobody's
Correct.
reached their 49%, but at
Correct.
some point of time, as REITs keep growing and you want to put in more assets into that REIT,
Yes.
you may have to leverage more. Will that be a limitation for a manager? Similarly, tenants. I mean, a large part of the tenants are currently multinational corporations who are, doing, say, BPO or KPO operations in India. Similarly, the lease risks, whereas you did say that because they do their fit outs,
Yeah.
most of them tend to keep renewing their leases, but I would suspect most leases would be a 3-year lease, which then keeps getting extended over a period of 3 years till 9 years, and then you renegotiate that lease. But are there significant risks associated for a REIT manager in the Indian environment?
Okay. So we are talking about operating risk. Now, REIT or no REIT, these operating risks any which ways remain.
Right.
But given the asset class that we are looking at yielding asset class. We are talking about core assets,
Right.
which are leased. While we have contracts which have 3 to 5 year lock-in, though the contracts could be 9 year, 10 year. For the reason which I mentioned, there's huge amount of stickiness. So you really, I would say, in the last 18 years that I've been looking at an office portfolio, we've rarely seen tenants exiting before 9 years unless they are shutting down the business. So that's the kind of stickiness you've seen.
Or they're building out their own facilities.
Or they're building the captive
which we have seen
facilities.
In Bangalore, many of the people seem to have done that. They've moved out of leased assets and built their own facilities.
But I think now more and more tech companies are moving to asset-light models.
Okay.
And that they prefer lease models because historically, you rightly said, everybody preferred their own campus.
Right.
But now people are actually moving out and want to go asset-light.
Right.
So therefore, these models are also getting traction. So now let me give you from a risk profile. I think we went through the worst time during COVID.
Right.
So when I want to take one asset class, an office especially, that was one of the most resilient asset class. So even during COVID, we received 99% of our contracted rentals because these were long-term contracts, 9 years, 10 years. And most of them, if you see today our portfolios, about 70-75% is MNC tenants, large MNCs, or otherwise they're large Indian corporates. Everybody honored their contracts. So despite the worst times, so when you talk about risk, during the worst time also you receive 99%.
Right.
Our occupancies generally are 95, 96%, otherwise pre-COVID. The worst thing that happened to us was we just went down to 85. We didn't go below 85. So we say in and around 85. We again started coming back to 90 plus. So I'm saying that's the worst thing that had happened to us. So even in that the worst time, we showed that amount of resilience. So while there is a risk, today if a tenant walks away, I take 6 months, 12 months to fill up. So to that extent, I lose my rent.
So work from home is not impacting you in any big way.
It did, and that's the reason why our occupancies came down. But now everybody's moved back to office.
Okay.
So today, if you see the physical occupancy at our parks, it's already been 80% plus. So therefore, everybody started moving back. So now I think work from home is a thing of past.
Okay.
Some hybrid models have evolved and shall forever remain, but otherwise, broadly, you're back to where you were pre-COVID. Now,
So
of
that's
course,
that 85 to 95 spike that you
correct,
saw.
correct. There could be some vulnerabilities, like for example, sometimes if you have, say, a mall portfolio. Mall, obviously, people stopped going to malls during COVID. So therefore, they saw those periods of not receiving
Right.
hall rent.
Footfall.
Some of them did, some of them didn't. But now they've gone back even above the COVID levels. It's come back with vengeance, so to say. So there are some business risks which remain. But I think given
What about geographical concentration? So if you just look at the REITs,
Yeah.
most of them are either in the Mumbai metropolitan area or in the
Correct.
Bangalore or
Correct.
the NCR.
Correct.
And beyond that, REITs haven't really expanded across geographies.
So that's because there are only 6 office markets in India. So you have NCR, you have Pune, Mumbai,
Right.
then you have the 3 south markets, which is Hyderabad, Chennai, Bangalore.
Right.
So there are only 6 office markets of relevance.
Right.
You may have smaller pockets in tier 2, but otherwise these are the 6 markets. And if you look at the 3 office REITs, they are present in all the 6 markets.
Right.
Not everybody is present in all the 6, but most of them are present in at least 3 to 4 markets.
Okay.
Okay, so to that extent, I think they are diversified. They may have some dominance in one particular market, but otherwise they have portfolio across those 4. Now, because there are just 6 markets in India, then obviously your concentration also is within the 6 ones.
Right.
But obviously you have spread well across these 6 markets. Of course, say a Mindspace REIT may be more focused on, say, Hyderabad, Mumbai, Pune. Maybe a Brookfield REIT is more focused on NCR.
Right.
An embassy could be in Bangalore. So I think operational risks are there, but REIT actually mitigates those risks because of the nature and the regulatory constraint, which doesn't allow it to do too much of development,
Right.
so to say. So I think that's where we are on the operational risk.
So, in terms of the servicing of your investor servicing, also
Yes.
there are a lot of complexities. I think in terms of disclosures, in terms of the 64B statements that
Yeah.
you need to prepare, the valuation of assets,
Correct.
because you need to do those valuations
Yes.
on a 6 monthly basis.
Yeah.
So those will also bring in complexity for the manager, right? The REIT manager.
Yeah, but that's the beauty of this product. It is so well regulated. And I think when SEBI came out with the regulation in 2014, they looked at all the international regulations across jurisdiction. And our regulation, in a way, sort of mirrors Singapore REIT regulation, because Asian regulations, we have very similar regulations.
Right.
I think this is one of the best governed instrument, very high on governance. So yes, from a manager standpoint, I invest a lot of my time on compliances.
Exactly. That is what I
Yes.
So that's
But I
the
think-
complexity for the manager.
Yes, for the manager for sure. But I think that is the most comforting factor for the investor, because you just see the amount of disclosures we make. I don't think a listed company gives, even a real estate listed company gives half yearly valuations, which we do.
Right.
And if you see, the whole valuation report is made public, which gives you all nitty-gritties in terms of what rents have been assumed, what growth has been assumed, WACC, cap rate, everything is transparently disclosed. You see the amount of, like a normal listed company gives only an annual report. We give reports twice a year, a half-yearly report and an annual report.
Right.
So that much more information comes. SEBI has prescribed a whole lot of information which needs to go out on a quarterly basis. So all of that, while obviously puts more pressure on a manager because there's so much more reporting you need to do, but I think that's the most comforting factor for investors, and therefore we are more than happy to do that.
To give those disclosures.
Give that comfort.
So you were talking about valuations. Now, if I were an investor and I needed to look at some of the metrics that I needed to understand before I invested into a
Yeah.
REIT, I would need to understand valuations. I would need to understand the leverage that the REIT has, the LTV, the fund from operations. even the adjusted fund from operations, because I'm sure there's a lot of maintenance,
Yes.
etc., which you guys will need to do. The cap rates, for example, the spreads between, interest rates
Yeah.
and what the rate is returning. The rental growth which you are talking about, which would happen after every 3 years or 9 years or whatever it is. How does he sort of get around understanding all this, and what are the most important things that he should be looking for in the, in the sort of these financial metrics?
You are absolutely right. There are a whole lot of nuances to understanding the product, and I think that's one reason the product has become popular more with institutional. Retail is slowly picking up because there's a whole lot of education to do, given the complexity of some of these, I would say, KPIs, so to say.
Right.
I think the key KPIs for somebody to look at, because this is a low risk or maybe mediocre risk product, I think couple of KPIs which really are the relevant ones for any investor. One, of course, is a concept called NOI, which we call net operating income.
Right.
In a REIT context, NOI is the most important operating KPI, and that's used worldwide.
Right.
So that's basically nothing your rent minus your operating cost for an asset. That's the NOI. So that's the growth in the NOI, how NOI is moving. That's, I think, one key KPI that every investor tracks. I think the second important KPI is your NDCF, which is a net distributable cash flow, the DPU, which is the distribution which we are making. How's that growing? What's the composition of that? We'll come to the composition. That's the second one. LTV, because SEBI any which ways limits our LTV to 49%.
Correct.
And therefore, how well we are geared, not geared, that's again an important KPI that any investor should look at. And then, of course, another one is, as we spoke of a little earlier, the concentration of the portfolio or the diversification of the portfolio. That's again something which a choice has to be made. So, for example, you say, I like this office market better, then fine, you take exposure to a REIT which has a larger presence in that office market.
Right.
So you have the choice to make. If you prefer a particular micro market, then you can decide on that micro market. But these are some of the KPIs I would, as an investor, track, which is your NOI, NDCF, your LTV. These are some of the key KPIs which actually tell you how is the health. Occupancy is important because occupancies went down during COVID, so now we are getting back. How well the parks are occupied, because that's what is going to generate rent for us. That's again another KPI to look.
So NOI would be similar to the adjusted funds from operations?
It's not a cash measure.
Okay.
Okay, so in a way, it's not funds from operation. It's an EBITDA, but
Okay.
before fee.
Before fee.
It's an EBITDA before fee. So that is way. I think another KPI, which obviously you have to look at it a little different, is your NAV. So we give out our NAV basis our valuation, because we have an independent valuer does a valuation. We give out every half year. Now, an NAV is actually a reflection of the intrinsic value of the portfolio. And maybe trading at X amount, but this is the intrinsic value of the portfolio. So say, for example, when I do a valuation, I get to a value of that one unit, and I say the value of my unit is, say, $300, and I may be trading maybe at 350, or I may be trading at 250. Depends on where each one is trading.
Intuitively, I think, or most usually, REITs trade at a discount to their NAV, right?
Okay, so if I were to, today all of us are trading at a
Correct me if I'm wrong,
discount.
but that's what I.
Today we are all trading at a discount to our NAVs.
Right.
But if you look at the 60-year history of US REITs, the average trend line is near NAV.
Oh, right.
Okay, there have been cycles when they've been trading at a premium. There have been cycles where they have been trading at discount. But if you take a 60-year trend line, then they are at NAV.
So I'm tempted to ask, do we trade at a discount to NAV because people are not very sure of the NAV? I mean,
I don't think it's about,
or the valuation methodology? What is
no,
the
it's
reason
not
for that?
about it's not about the valuation, but I think it's more, today if you ask me why are we trading below, I think one big contributor is liquidity. So what happens is, today, for the product to become far more liquid, there are multiple factors which really come to play. One, clearly, we need more larger investor base.
Right.
So as I said, we started as FPI, then mutual funds came, insurance came, now slowly pensions are coming. But all this investment has come from the private side. So we don't have really government insurance companies, government pension funds, which have come big time. They have a huge pool of money, but that money is still not come. Second, we are not on indices. So we don't get passive money. We are like any other listed stock, but today we are not on indices. So for example, if you take the REITs, they are equity, classified equity in any other jurisdiction internationally, and we are in the equity indices globally. So if you take the REITs, for example, we are already in, say, MSCI, FTSE, S&P, more than 100 indices. The same Indian REITs are already there in global indices.
Right.
But we've not found a place in the Indian indices.
Right.
Now, there we are not finding place because obviously the question is, are these equity or are these hybrid instruments? That's where the debate is. Now, SEBI's come up with a consultation
Correct.
paper on
I
this
was
exactly.
just going to ask you that. So
Correct.
and there is a consultation paper which says that is it time for us to increase the exposure that mutual funds are allowed in REITs?
Correct. Correct.
And there is a point of view which says that it works both ways, because then what happens is that if you're pushing them to put money into REITs and the total market cap is just 95,000 crores, then what would typically happen is you have people chasing these assets, which would lead to unrealistic valuations. So how would you respond to that?
Yeah. So today between REITs and InvITs, today we are 8 publicly listed REITs and InvITs. Privately listed, everything is listed. There's nothing like unlisted on the REIT or InvIT side. So everybody is listed, irrespective of whether private or public. But on the public side, today we are, say, 8. But I think it's a matter of time when we'll get larger. Now, even between the two, I'm not saying that it's too small. You still are around 1.2 lakh in terms of market cap. So we are not saying we are small. If you look at, say, let me take an example of Nifty 500. And if you look at the bottom percentile, we have much larger than some of those. So if you look at our market caps, we are 20,000, 30,000, 40,000 crore market cap. So we are not small, so to say. We are, the number wise, we may be small, but individually, we are larger than many of we'll be somewhere, I'm just saying, in the 300 odd range, plus minus.
Right.
And then, therefore, the question is, why should we not have access to passive funds also? If you look at even the return profile, I'm talking about, say, a 12-14% return. And if you take Nifty return over the last 20 years, that
so
also
you could be part
maintained.
of a mid-cap index or a small
Maybe,
cap
yeah,
index.
we are not talking about being a Sensex or Nifty.
Right.
But we may find place in, say, Nifty 500.
Right.
We may find place in some other of those. So I'm saying, even if we find place there, we'll have passive money which is coming. I'm saying we may remain or hybrid or whatever, we remain as maybe equity only for the purpose of getting classified. But getting into indices helps liquidity. So coming back to your question, why are we trading below NAV? So I think one key contributor is the liquidity. And of course, awareness. Not too many people are still aware.
Right. So I also wanted to ask you that from operating parameters also, people need to track an investor.
Yes.
I mean, both the institutional and the retail investor needs to track occupancy rates, the lease mix, and he needs to make an reasonably educated assessment of how these things will move. So how easy or difficult would that be for an investor?
I think one of the best things SEBI has done in the recent past is getting the data benchmarking institutes in place.
So where does he get this information from, the investor?
Exactly. So there are 3 platforms today. 3 of them have actually started something called as data benchmarking institutes.
Okay.
So what happens essentially with this data benchmarking? They gather all the information of all the REITs at one place, and all the KPIs are compared versus each other.
Okay.
So if you go to their portals and look for the information, all of them actually have that information stacked together in one place, well analyzed for the investors to make sense of them. Plus you have, like for example, the Indian REIT Association, the Bharat InvIT Association, which also puts all information about the 4 REITs and they're the InvITs. So these are some places where investors can easily find all that they need. And the Data Benchmarking Institute, I think it's the best thing that could have happened to investors. They have to just go to those portals and they have every information together. Compared for all 4 REITs together, makes it so much more easier. You don't have those platforms for listed companies as you have for REITs.
Right. But if he wanted to take a view of where does he see occupancy rates going, or where does he see the lease rentals going, etc., he would then have to do it like any other researcher does, who tracks the real estate space.
So if you, in fact, we make life much more easier even there. So if you see most of our valuation reports, they come along with industry updates, which come from the valuers. We also engage the IPCs, which we call International Property Consultants.
Correct.
We have their reports also available. So if you go to any of our websites, together with the valuations, there is a big report on how is the industry doing, and it's an independent view of what's happening in the industry.
Okay.
All of that is available on our website. So if anybody wants to even understand what's happening in those micro markets, all
They can.
information is available for them.
Right. Now let me come back to the distribution income which you had mentioned in between. So it seems to be incredibly complicated for a lay investor, simply because you have something called dividend income, you have something called interest income, you have something called debt repayments, other income. So whereas all of us understand that you need to pay out 90%, right? A lot of it comes from these different sources. But more importantly, I just wanted to understand, is it that you could keep back something and pay it out of somewhere else so long as you meet that 90%? And how does an investor make sense of each of these components?
So there are essentially, of course, it sounds complex, but let me break it and make it easier. So there are three components essentially by which the distributions go to the investors. One is dividend, which all of us understand, plain simple dividend, which you otherwise get from other listed companies also. So that's one component. The second is interest.
So all rental incomes,
Yes.
which pass through this pooled instrument, have to be paid out as dividend.
Yes.
Okay.
So all the cash flows have to be paid. So
Okay.
there's a big difference. It's not the profits, it is a cash flow which needs to be paid. And it's because of this regulation.
But beyond rental income, what other cash flows would they be?
No, it is rental income, but the profits versus cash flow, because you have non-cash items like depreciation. Let's just take depreciation. I want rent of $100.
Right.
Say $10 is depreciation,
Right.
so I'm left with 90.
Right.
Companies Act allows me to distribute only 90 by way of dividend.
Right.
So I've paid 90 from the SPV to the REIT and then onward to the unit holder,
Correct.
the $90 as dividend.
Right.
But the REIT regulation requires me to pay even the 10 because 10 is my cash flow. It's not my profit.
Okay.
But 10 is a cash flow.
Right.
And I have to distribute cash flows, not profits.
Right.
So how do I take the 10 out?
Right.
That's where the complexity comes in. So how do I make sure that the 10 is also upstreamed and given to the unit holders?
Correct.
So that's where the interest part and the return of capital or amortization of loan, as we call, comes in.
Right.
So today what happens is there's nothing at the REIT level. The REITs are just holding companies. Operations are at the SPV. So when REITs also borrow, say we do bond issuances at the REIT, the money is then given by way of loans to the SPV.
Correct.
SPV can refinance, SPV can do construction out of those loans depending on the purpose.
Right.
Now what happens is when there is extra cash available, which is a depreciation trap which has happened, the 10 rupees which is sitting in the SPV gets repaid to the SPV, say to the REIT. Now REIT has, all of us have done our IPOs. There is primary money which got raised at the time of IPOs, which has come down and it's gone to the SPVs below.
Right.
The primary money which came in, today say I have repaid that money. So that money has gone back to the REIT, the 10 rupees,
Right.
which was a distribution, I would say non-cash item. Now that 10 gets distributed to the unit holders as return of capital. That's why you have this component called return of capital. And because the SPV used that primary money, which came from the REIT, and they have to pay interest also because everything happens at arm's length. So there is interest also which goes to the REIT. But that's primary money, so that interest doesn't have to service anything else.
Correct.
So that interest again goes back to the unit holders.
Right.
That's why you have these three components. You have dividend, you have the return of capital, and you have interest.
So in the 2023 budget, there was some, they introduced a provision where this return of capital also
Yes.
would get taxed, which was not happening, which again complicated, the sort of situation for the investor. So how does an investor now sort of tackle that part of it?
So in fact, they clarified, and it's really good that the clarification came in because otherwise there was ambiguity. How do you even look at this from a tax perspective? Now what happens? They've actually simplified. Whatever I give you as return of capital or amortization of loan, all that you need to do is you reduce from your acquisition cost of the unit.
Right.
You don't pay tax when you receive it.
Right.
Just reduce it from your acquisition cost. So effectively what's happening is when you sell the units, you effectively are paying capital gain tax on that money which has come to you.
Right.
So you don't pay tax on it immediately. So when you sell, you'll end up paying capital gain tax. So actually it's not that simple, but it's just that you're getting in different forms makes it complex.
So how does this compare from a taxation perspective, to say the tax that you would pay on the interest income that you get from a bond or a government bond or?
So I would say this is one of the most tax efficient
Yeah,
as
so-
compared to a bond.
Right.
Today, if you receive an interest from, say, any bond, it's fully taxed.
Correct.
Whereas in case of a REIT, the dividend, first of all, that comes to you, it's fully tax free. So you don't pay any tax on
Correct.
that. Even if you take the next one, which is the return of capital, which is a large component, there again, you're not paying, firstly, you're not paying tax on receipt. You're paying only when you dispose the units.
Right.
Secondly, even if when you dispose a unit, you're paying capital gain tax and you're not paying your marginal rate of
Right,
tax, which you would have otherwise paid on interest.
Correct.
It's only the interest component where you pay, the domestic investors pay marginal rate of tax. So if you compare with others, it is still one of
It's a
a
very
relatively tax efficient instrument.
Now, SEBI, the next question I had, Preeti, was that SEBI has introduced this new category of REITs, SM REITs or
Yeah.
small and medium REITs. So, how are they different from commercial REITs? I mean, obviously, the size obviously is one big difference that they have, but I think there are a lot of other nuances that are there. And more importantly, I mean, I think the intent of coming up with these SM REITs was basically to move all these fractional ownership
Yes.
platforms into a regulated structure.
Correct.
And that is a reasonably large market, I think.
Correct.
Do you see all of them moving into the SM REIT structure? Is
Okay.
there any case for that to happen?
Yeah. So very, as you rightly said, the whole purpose was because there was money which was being taken from investors and it was getting deployed in real assets.
Right.
But there was no governance structure around that.
Correct.
So SEBI rightly put them under SM REIT structure,
Right.
where there's a very well defined and a very robust governance structure. So anybody who's even in those pooled vehicles or fractional ownership vehicles, if people are putting money now, at least they are very well governed. Disclosures, transparency, reporting requirements are very similar. In fact, they are far more stricter because these are smaller ones, so therefore they need to be even more governed. Today, you already have a lot of them who are wanting to transition from what they were into SM REITs. And I think it's actually in India. Today, if you see, we as Indians like to own assets. Real estate is very popular in India.
Right.
And today, a lot of us have smaller commercial assets. People would have bought 1,000 square feet and 1,500 square feet and so on and so forth. But when you actually buy a physical asset, it comes with its own nuances. Today, you have to manage that asset.
Right.
If a tenant moves out, you have to rent that, upkeep. There are several challenges when you yourself have to manage.
Correct.
Now, when you have these SM REITs, besides, of course, if you want to take a large exposure to the larger REITs, then of course you have the conventional or the mainstream REITs. But if somebody says, I want to put an HNI, for example, says, I want to put a huge amount of my money, but I want to get a larger pie of how that REIT is doing, then your SM REIT can come handy, where you can be a larger investor, but in a smaller vehicle, which is getting equally regulated, instead of being a smaller investor in a much larger vehicle. So I think it's going to be individual choice, or you can say, I want only exposure, say, to a BKC market. Forget about Pan India, forget about Mumbai. I want only BKC. Then you have an SM REIT which would have assets only in BKC because they are the smaller vehicles. So it gives you those benefits of choice if you so desire.
But given the fact that it seems to be a bit of a misnomer, we call them small and medium REITs. But the minimum amount that you need to put into a
10.
SM REITs is 10 lakhs,
Correct.
which somewhere sounds intuitively difficult for people to understand.
Yeah, but that's because SEBI wants to make sure that only people who are investing in these products, because there are small and medium, so they need to, I think, evolve to a stage where they get into those kind
Are
of.
we indirectly saying that the risks are higher in the SM?
It's not risk, but I think SEBI has been conservative with these instruments, that only people who have good knowledge of these assets
Right.
come in. Like it happened even with REITs, for example. Our lot sizes were 50,000 first.
Right.
Then over a period when SEBI got comfortable that yes, everything is now in place and we can reduce, they reduce it to just one unit. I think it's here also it could be an evolving thing. Today starts with 10 lakhs, but once SEBI is also comfortable that yes, everything is going fine, they could look at reducing this.
Right. Preeti, I had one last question. And that is, just like how mutual funds have been able to push their product and then made them something like, investments that every household has
Yeah.
today. What is it, what do you think should be done in the REIT space to ensure that, Indians take a greater and greater exposure to this product? As you rightly said, Indians love property. They do invest directly in property.
Yes.
Wherever affordability is there, they buy a house or buy property or commercial property. So how do you think that we could push REITs as a product to the Indian investor?
Right. I think that's one of the most pertinent questions. Today, the whole, I would say, the biggest agenda, so to say, of the Indian REIT Association, the primary focus today is creating awareness of this product, making more and more people in India aware of what REITs are, making sure that you have those programs. We do so much across the year to just make sure that people are educated, told about this. And I think this is becoming, in fact, one key issues which is also affecting liquidity, because you're not having too many people who are actually getting to know what these products are, what are the nuances. Today, for example, even after say 5 years of us being in this space, we have just about 2.5 lakh investors on the REIT side. You lose count of the number.
And
Even
mutual funds
mutual
also.
funds is more than 4 crore in
Right,
India.
correct.
We are just 2,50,000.
Correct.
That's the penetration which we've had.
Right.
So you can see the scale.
Right.
And that's in fact an opportunity for us.
Right.
We need to do the right things to educate. And as Indian REIT Association, I think that's one of the fundamental reasons why we formed the association. And that's one key purpose, is to make sure we spread education. Now, like we're doing this program, and I'm sure this is going to help us big time in spreading the awareness. But all through the year, we do several podcasts, programs. We tie up with various education institutes, not just education. There are many other platforms which help us in disseminating information about this product. We do a lot of programs even with institutional investors. I'm not saying they've come big time, but we want more and more of that to come. So I think education is one key mantra for us to get more and more people understand the instrument and the beauty of this instrument. They are right. So we are not saying that this should replace any other form of investment.
Right.
All that we are saying is, as all the other instruments, REITs also should find a place in your allocation.
Right.
That's all we are saying.
Right. Thanks so much for your
Pleasure.
time, Preeti, and this was a very, very fascinating discussion.
Absolutely. Thank you. Been a pleasure being here.